Here's the main problem why many day traders fail to trade effectively using moving averages. It's the false breakouts or whipsaws that occur when price moves back and forth, crossing the line you apply on your chart. You know the drill. As the price moves above the moving average, that's a buy signal. As the price moves below, that's a sell signal. But the market isn't perfect. You get one signal, a move across the moving average, followed shortly by an opposite signal. These false signals almost always result in a small loss. The same problem happens when you apply a crossover system for scalping or day trading. Moving average crossovers only work when the market trend for a substantial period of time. That is when the moving averages you see on your charts look all nice and pretty. Only problem is that those nice and clean trends don't always happen. When the ranging markets come and the false breakouts start to happen, the moving average traders tend to start taking losses as the markets tend to reverse once the moving averages trigger an entry. So how to reduce the false signals, because we can completely remove them? The problem is that when we apply a moving average study, we focus on the line that appears on our charts, which is plotted based on the closing price. And that's a very small margin. Instead of plotting the moving average based on the closing price, I use a moving average channel. Here's how it works. We have two moving averages forming a channel, which are applied to the bar's high and low prices instead of the bar's close price. So instead of one moving average, you'll have two moving averages on a chart. Instead of focusing on just one line, you'll have an area. This moving average channel will filter a lot of false signals and will save you a lot of losing trades and lost money. The moving average high-low channel tries to find trending markets and is extremely useful for staying out of sideways markets. The channel turns a simple moving average into a zone of support and resistance. In a market with a strong trend, prices may trade either above or below the channel. Some traders prefer to buy or sell breakouts above or below the moving average high-low channel. Others tend to use the resistance and support areas as zones to establish a market position in the direction of the dominant market trend. Remember that a moving average lags and responds to price. This is why you must analyze it together with price action. And my favorite way to trade price action is by using Heikin Ashi bars. When using Heikin Ashi, you can trade it the same way as you would a traditional candlestick chart. The difference is that prices have been smoothed out to reflect directional bias. As with candlesticks, you might use chart patterns with the Heikin Ashi, but your view might be better informed by the consistency in the color coding, which may indicate reversal bars more clearly and sometimes more accurately. So by using the moving average channel and Heikin Ashi combination, we plan to remove the noise and false signals, and to catch longer and persistent trends. Trend detection is one of the main functions of this strategy, because both Heikin Ashi and the moving average channel put an emphasis on persistent trends. Small corrections and consolidation are left behind, and they are barely visible on the chart. You'll notice that when the direction changes on a Heikin Ashi graph, the price most likely starts a new move. This helps to distinguish between the potential beginning and the end of a trending move. With the Heikin Ashi chart, you can distinguish strong trends from weak price action. At first glance, the bullish Heikin Ashi trend looks like a normal Japanese candlestick trend. However, you will notice that the Heikin Ashi trend is built primarily by bullish candles and is absent of lower candle wicks. When the price is shooting up, the price action creates very little to no lower shadows. The bearish Heikin Ashi trend has the same functions as the bullish one, but in the opposite direction. This means that it is built mainly by bearish candles. Also, a strong bearish trend on the Heikin Ashi graph has very little to no upper candle shadows. Here we are using a 50-period high-low channel on a Heikin Ashi chart. However, you can experiment with different lookback periods to see which one works best for you. Higher settings tend to work well for observing trends, and the lower lookback periods are good for timing. First aspect we need to do is to determine market direction. The primary function of this day trading strategy is to smooth trends. When the channel is pointing up, we have a bull trend. When the channel is pointing down, we have a bear trend. By the way, I use this indicator on Tradingview. When the moving average channel is sloping upwards, the lines are green. When it's sloping downwards, the channel is red. And when the moving averages are flat, the channel is gray. But the markets aren't always that simple to analyze. To make sure that you are not trapped at the end of a trend, we need to examine price action using Heikin Ashi. When the Heikin Ashi price structure aligns with the moving average channel, the market is trending. When they oppose each other, the market is slowing down and might be reversing or retracing. For an uptrend, the price is above the moving average channel, the channel is green, and the Heikin Ashi candles are green. For a downtrend, the price is below the moving average channel, the channel is red, and Heikin Ashi candles are red. The range of the channel is related to the look-back period. Fast-moving averages respond quickly to new price data and could form steep lines, but slow-moving averages are weighted down and show more stable slopes. When the price is inside the channel, I avoid opening any position. This is the no man's land, a period of indecision, where you want a clear breakout on any side of the channel. I also avoid opening positions when the slope of the channel changes from upwards to downwards to flat in a very short period of time. When this happens, you can see the price breaks the channel in both directions. The market consolidates, so there is no clear trend on the market. You must also analyze the distance between the moving average channel and Heikin Ashi candles. In a sideways market, price tangles with the moving average. There is little or no gap between price and the moving average channel. In a healthy bull trend, the price stays a fair distance above the moving average channel and stays below in bear trends. In an overextended trend, you'll find a striking distance between Heikin Ashi candles and the moving average channel. So the strategy is very simple and very effective at the same time. A breakout above the moving average channel with green Heikin Ashi candles signals buying pressure. A breakout below the moving average channel with red Heikin Ashi candles signals selling pressure. Pay attention to the slope of the channel, the distance between the candles and the channel, and you'll eliminate a lot of false signals. Depending on your level of experience, you can add other filters to find the best setups. Here's a great one, the ADX indicator. The average directional index will confirm if the market is ranging or a new trend is likely to take place. ADX is plotted as a single line with values ranging from 0 to 100. ADX is non-directional and registers trend, whether price is trending up or down. ADX values will help you to identify the strongest and most profitable signals. I personally ignore all signals if the ADX line is below 20. ADX readings above 20 suggest that the trend is strong enough for trend trading strategies. Low ADX is usually a sign of accumulation or distribution. When ADX is below 20 for more than 20 or 30 bars, you will see that price enters range conditions, so ignore the signals that we find, because they will have a low probability of working out. When ADX is below 20, price will usually move up and down between resistance and support to find selling and buying interest. When the ADX line is rising, trend's trend is increasing and the price moves in the direction of the trend. When the line is falling, trend's trend is decreasing and the price enters a period of retracement or consolidation. Here are several examples with ADX filter. Another filter is the regular divergence. I'm a big fan of combining leading with lagging signals to confirm my trades. And one of the most powerful trading signals that combines price action analysis with the use of indicators is the divergence signal. Regular divergence is used to forecast an upcoming price reversal. When you spot a regular bullish divergence, you expect the price to cancel its bearish move and to switch to an upward move. When you see a regular bearish divergence, you expect the price to cancel its bullish move and switch to a downward move. Divergence trading is an extremely effective way to confirm our strategy. The reason for this is because divergence formations are leading signals. This means that a divergence pattern is likely to occur before the actual move. This way, we are able to anticipate and enter the trade using our strategy right at the beginning of a new emerging move. Here are several examples with MACD histogram divergence as filter. Being a day trading and scalping strategy, you could use any time frame between the 1 minute and the 15 minutes. And when it comes to selecting the markets for using this strategy, it's vital to pick one that is volatile, so that you are more likely to see a high number of moves. As always, if you learned something new and found value, leave us a like to show support, subscribe to our channel and click the bell icon to stay notified every time we upload a new video. Until next time.